The FedLife podcast is presented by Serving Those Who Serve, a fiduciary, fee-based financial planning firm serving federal government employees and retirees all over the country. This podcast is for informational purposes only and is not intended to be taken as financial advice. All listeners should consult their personal advisors before taking any action. The opinions expressed by our hosts are their own and do not reflect the views, policies, or position of Raymond James. Securities are offered through Raymond James Financial Services, Inc., member FINRA SIPC. Investment advisory services are offered through Raymond James Financial Services Advisors, Inc. Serving Those Who Serve is not a registered broker-dealer and is independent of Raymond James Financial Services, Inc. And now, here are your hosts. Dan Sipe serves as a branch manager for Raymond James Financial Services and Serving Those Who Serve. Ed Zerndorfer is our guest and federal benefits expert in the space.
Hello and welcome to this episode of the FedLife podcast. If you don't know me, if you're new, thank you for joining us. I'm your host, Dan Sipe. Additionally, I'm the branch manager here at Serving Those Who Serve, Sipe Associates. I'm going to begin, as I always do, by saying thank you. Thank you for taking the time to listen, and above all, thank you for your service to the government, to the country, to me, to everyone. You don't hear it enough in normal times. You are definitely not hearing it enough right now. So you always hear that here. The other thing you always hear here is the guru, Ed Zerndorfer. Ed is back with us once again as part of our ongoing mission to reach, teach, and serve you. Once again, we will follow Ed's FedZone articles. You can find those at fed-zone.com, which I encourage you to do. Even if you're watching or listening to this, go ahead and download that because we've taken the notes for you. So you don't have to feverishly scribble through this. And it's one more way for us to reach and teach. Ed, wow, our feds are going through a lot right now. And I really appreciate, a lot of the content that you've been generating to help them make sure that they get what they need to help navigate those challenges to make sure they get everything they're supposed to get. And your article covering healthcare flexible spending accounts and health savings accounts is pretty important because some of our feds may need to make some decisions if they are departing. So, Ed, if you don't mind, let's remind folks what healthcare FSAs, LEXHCFSA and HSAs are.
Yes, I will, Dan. And I just want to repeat what you said, that I agree fully with you. There is, federal employees are facing a lot of challenges now. It is really, it's a challenging time. I've never seen it like this. I've been through, I was the government for 32 years, went through a few of these things, but this one, over the past few months, has been the biggest challenge for federal employees, in my opinion.
Agree.
And my columns and the FedZone columns have been, over the past few months, have talked about some of the issues, one of which is one we're going to talk about today. Because there is a tremendous lack of information out there. OPM is not giving out any guidance, and that's why I'm picking up what they should be doing. That's why I'm writing these columns. And this particular column on healthcare FSAs, limited expense healthcare FSAs, and HSA is one of the issues that I covered in one of my FedZone columns. So to begin with, what is a healthcare FSA? And I'll talk, and related to that, the limited expense healthcare FSA. Federal employees, and I emphasize only employees, not retirees, have an option to set aside part of their gross salary in one of two flexible spending accounts, an FSA. And they are a healthcare FSA, and the other one's called a dependent care FSA. The healthcare FSA, in which employees, I say, set aside a part of their gross salary, is used to pay out-of-pocket medical, dental, and vision expenses. Now, an employee can be enrolled in any type of health insurance plan, dental insurance plan, vision insurance plan. They don't have to be enrolled in the federal employees' health benefits program. They can be covered by TRICARE if they're a military retiree. An employee could be covered by a spouse's health insurance plan. The spouse works in private industry. The same thing with dental, vision insurance plans. And I always say this, Dan. There is no health insurance plan out there. There is no dental insurance plan out there. There is no vision insurance plan. which pays for everything.
Very true.
Employees have out-of-pocket expenses, whether they are deductibles, whether they are co-payments, co-insurance, there are health insurance plans, dental insurance plans, vision insurance plans that don't cover certain expenses. So the question is, how does an employee pay for out-of-pocket expenses, deductibles, health insurance, co-payments, co-insurance, things that the insurance plan does not pay for? How do they pay for it? With pre-tax dollars or post-tax dollars? The best way, in my opinion, is with pre-tax dollars. And I'm going to give an example in a few moments. So that being said, all employees during the annual open season, which sells from the second Monday of November to the second Monday of December, are allowed to set aside for the following calendar year, a part of their gross salary to put into this healthcare FSA. How much could they put aside? Well, goes up every year. This past November, it was $3,300. $3,300 was the maximum amount they could set aside for themselves to pay for out-of-pocket expenses for themselves, for their family members, spouses, children, whether their children are included on the plan or not. If they have an adult child that say is over, let's say over 22 years old, between 22 and 26 years old, and they have their own insurance, they actually can actually pay for their the employee can pay for their out-of-pocket expenses as well. So that is the healthcare FSA. Now, a couple of things got to be kept in mind about the healthcare FSA. The employee has to make that election, how much they want to set aside. For 2025, it was a maximum $3,300. $3,300 was the maximum. And the way it works is, starting with the first pay date in January, the employee would have whatever they set aside for the year divided by 26. So if they set aside $3,300 for the year and there are 26 pay days, if you divide $3,300 by 26 pay days, that means each pay date, I got to check my math here a little bit. Bear with me here one moment. That would set aside $126.92 would be deducted from their gross salary before all taxes, federal, state, Social Security, and Medicare Part A, to be used to pay for out-of-pocket expenses for themselves and their family, for medical, dental, and vision expenses. Now, as I say, it's spread over 26 pay dates in this case here. Now, the rule is that an employee it's a use-or-lose situation. They have to use up all their money by the end of the year, although they are allowed to carry over a certain amount each year. And for this year, it's a maximum $670. It's use or lose. Now, what happens if the employee retires in the middle of the year? Well, retirees don't have this benefit.
Gotcha.
Retirees do not have this benefit because when you're a retiree, you cannot have a flexible spending account. Why not? Because that money is being set aside from one's salary. You cannot have it set aside from one's annuity. All right. So when an employee retires, before they retire, they got to use up all their money, or else they're going to lose it. They're going to lose whatever's left in that account.
Gotcha.
If an employee leaves federal service, and this is what's happening now, we hear about these deferred resignation offers.
Sure.
That's happening. Employees have to be off the payroll. They have to resign no later than September 30th. That's what I'm hearing. So employees got to keep in mind that if they have any money left over in their healthcare FSA, by the time on the day they resign, that money is going to be lost.
Ooh, not good.
So they have to use it up. Now, let me just mention about the limited expense healthcare FSA before I get any further. There's another type of health savings account, another healthcare savings account we're going to be talking about here in a moment. It's called an HSA, health savings account, which we're going to be talking about here in a few moments. The rule is that if you are enrolled in an HSA, you also cannot be enrolled in a healthcare FSA.
Okay. With
one exception. If you are enrolled in an HSA, you're allowed to enroll in what's called a limited expense healthcare FSA, better known as a LEXHCFSA healthcare FSA.
Okay.
Limited expense, meaning what is it going to pay for? Only dental and vision expenses. So the same rule would apply when it comes to the limited expense healthcare FSA, that if you have any money set aside, left over in your limited expense healthcare FSA, by the time you retire or leave federal service, you have to use it up to pay for dental and any dental or vision expenses for yourself or members of your family. Now, I want to just share with you something, Dan, that's very interesting that's unique with the healthcare FSA and limited expense healthcare FSA. I'm going to go back to the time that when I was a retiree, I retired from federal service back in January 2006. In fact, January 31st, 2006. And I enrolled in the healthcare FSA for the year 2006 during the open season, which was held from November to early December 2005. And how much did I set aside? I set aside the maximum. Back then it was like $2,600. And people said to me, employees said, "You're crazy. Are you going to be, you're going to be using up $2,600 in 1 month?" I said, "Yes, I am. So they said, "How is that possible?" Well, I had one pay date in January 2006, in which they took out $100, $2,600 maximum for the year 2006 divided by 26 pay dates is $100. So during the month of January, this is January 2006, Dan, I went on a medical and dental and vision spending spree. I always had my physical in January, my annual physical, so there's a deductible. Sure. I had kids. I had 2 kids in orthodontics.
Oh, well, that's okay.
Yeah, how much that cost, Dan?
Yes.
So I said to the orthodontist, "Could I prepay this year?" The orthodontist says, "Of course you can."
Shocker.
So I asked for an advance for my healthcare FSA of $2,000. $1,000 for each child.
Gotcha.
He said, "Well, how's that possible? How's it possible? You only had $100 with health in your healthcare FSA." You can get advance the money, because and that's true in general. So how is the healthcare FSA administrator going to get their money back? Well, you're going to be working the rest of the year. They'll just take the money out from the rest of your paycheck. But when you retire, that's not going to be the case. They are going to swallow it. They're going to advance you the money, and that's perfectly legal. And you say, "Well, how could the healthcare FSA afford to do that?" Very simple. For every one person like me, Dan,
yep,
there are 2 people who have money left over in their healthcare FSA by the time they retire or leave federal service, and they're going to lose that money. Who keeps it? The HSA, the healthcare FSA administrator.
Gotcha. Okay, folks, listen up. This is a life hack from the guru. Okay.
It worked for me,
I
and
believe
it worked for other people, because I advise people in my practice. I advise people to do that.
You are nothing if not thorough.
This is what I'm advising everybody now who is going to be leaving or retiring. You might be retiring early from federal service. It's the same thing. If you're going to retire, let's say on June 30th this year, May 31st, whatever it is, that's a few weeks away. Use up the money. Advance the money. You will not have to pay it back.
Fantastic.
This way you'll end up, if you don't use it up, you're going to lose the money. You're going to lose the money. So that is what I want to share with everyone. And I think, Dan, let's go through an example here, if it's okay with you.
Please do.
Before we go. All right. My example, and this was in the column, we have a person named Dina. Now, Dina enrolled in a healthcare FSA during the 2024 FSA Feds open season this past November. And she elected to set aside the maximum $3,300 to her healthcare FSA for 2025. Starting with Dina's first pay date in January 2025, she had, this is again the $3,300 divided by 26 pay dates, or $126.92 being deducted from Dina's biweekly salary before all taxes. So what that means is whenever Dina or a member of family incurs a medical, dental, or vision expenses, Dina can request funds from her healthcare FSA to either reimburse Dina for the amount she paid or to pay the medical provider directly. They have a direct payment option, okay? Dina can also ask for an advancement of her healthcare FSA to pay a healthcare provider even though the medical procedure has not been, or dental or vision has not been proceeded, just like I did. I asked for an advancement. It works. And by the way, when we talk about the HSA in a few moments, that's not the case. That is not the case. You can't do that with an HSA. So,
Wow.
That's what I advised. That's what I advised.
Great tip, Ed.
Dina to do. And that's what I advise anybody listening today who's going to be leaving federal service. Deferred resignation offer. You're going to go out whenever, September 30th, and you have money in that healthcare FSA or Lex or limited expense healthcare FSA. Again, that's the limited expense healthcare FSA is only used to pay for out-of-pocket dental and vision expenses. Advance the money before you leave federal service or retire early. This way you will not lose it.
Gotcha. Heck of a tip, brother. Heck of a tip. So now we've covered the healthcare FSAs and living expense healthcare FSAs. You talk about the HSAs, and they do behave a little bit differently. So let's talk about that.
Okay. So a health savings account, it's similar to a healthcare FSA, but there are some differences. Again, any contributions that are made to the HSA are used with pre-tax dollars before all taxes.
Gosh.
And actually, a contribution that you make to your HSA is an adjustment to your federal income taxes, an adjustment to income. There is a maximum that you can contribute each year. Money in the HSA grows, and it'll grow tax-free. It accrues earnings, which the healthcare FSA does not. And when you pull money out of the HSA to pay for qualified medical, dental, vision expenses, it's tax-free. So what do we have here? We have what I call the trifecta effect when it comes to taxes. Tax deductible, contributions going in, tax deductible. Earnings grow tax-free. Withdrawals are also tax-free. So it combines combines the benefits of a deductible traditional IRA and the tax-free benefit of a Roth IRA.
Absolutely.
All withdrawals are good. So these HSAs are good. Now, there are other great features about the HSA. One great feature of the HSA is the fact that there's no use or lose. You take it with you.
Nice.
If you leave federal service, you resign or you retire, it goes with you. It can be used anytime. Take money out, tax-free. You used it for qualified medical, dental, or vision expenses. It also, if you're over 65, when you're over 65, you can use it to pay other expenses, except you got to pay taxes, but no penalty. If you're under 65 and you take money out of your HSA to pay for anything but medical, dental, vision expenses, qualified medical expenses, you will pay a 20% early withdrawal penalty.
Ouch.
In addition to taxes, in addition to federal and state income taxes.
Don't want that.
So you don't want to do. Now, the one thing you got to keep in mind about the HSA, Dan, unlike the healthcare FSA I mentioned, you can be enrolled in any type of health insurance plan, fee for service, preferred provider organization, an HMO. You don't have to be in the federal employee health insurance. You could be enrolled in TRICARE on your spouse's health insurance plan. Your spouse works in private industry. But with an HSA, you have to be enrolled in what's called a high deductible health insurance plan, HDHP.
Got it.
And what does high deductible mean? Every year the IRS defines what high deductible is. This year in 2025, high deductible means that if you enrolled in an if you in a high deductible plan, your deductible, it has to be minimum for self only $1,650.
Gotcha.
For self plus one or self and family, $3,300. And I know what the listeners are thinking now. Wow, that's a pretty high deductible. That's a lot of money. Dan, I can remember the days where deductibles were a couple $100,
Sure.
maybe $100, $200. What are deductibles now for self only? $1,000?
Yeah.
You know, and for self and family, it's $2,000. You know, that's $1,650 and $3,200. It doesn't seem all that much, but also you got to keep in mind that you don't have to meet your deductible for certain medical expenses like well visits.
Sure.
Your annual well visit. I think that employees should not get discouraged about that that minimum.
Especially our younger
There is
feds.
There is a cap on the maximum out expenses. There's a catastrophic limit.
Yeah.
But to me, the beauty of the HSA is the fact that you're able to save in a tax-free way. There's no use or lose situation. You take your HSA with you. You take it into retirement to pay for out-of-pocket expenses in retirement. And here's another beauty of the thing about you can use withdrawals for your HSA for. And I think a lot of retirees are going to be happy to hear this one. That you can reimburse yourself, take money out of your HSA in retirement to reimburse you for the cost of Medicare Part B.
Nice.
Medicare Part B. We hear all these complaints. Oh my God, Medicare Part B, I got to pay for that. Well, you do, but normally it's deducted from your Social Security check. Well, you can get reimbursed for it by taking money out of your HSA tax-free.
Absolutely.
You can use your HSA before age 65 to take money out of to pay your long-term care insurance premiums.
Nice.
We know long-term care insurance is expensive. So this will help you pay those long-term care insurance premiums. I love those HSA, Dan. I love them.
Oh, I know you
love
do.
them, and they are here to stay.
Agree.
More and more companies are adopting them. Retirees can, as I say, can take their if you retire from federal service, your HSA goes with you in retirement. But keep in mind that when you enroll in Medicare, you can no longer contribute to your HSA when you enroll in Medicare. That's the stopping point. You can take money out. You just can't put any more money in.
Gotcha.
For those employees who are going to be leaving federal service, they're resigning. They're not retiring.
Gotcha.
And they take their HSAs with them. The answer is yes, they can.
Okay.
That's theirs to stay. So if you're going to be resigning from federal service, can you fund your HSA? Well, the answer is if you're going to be leaving federal service, you'll be losing your federal employee health insurance benefits. You're not retiring. You're going to lose your federal employee health insurance benefits. So obviously you can't walk around with health insurance. What are you going to do? Are you going to work for a company? Hopefully you'll find a job that offers health insurance. If that company offers high deductible health insurance plans, then you can fund an HSA. You can fund an HSA there. You can then combine your HSA with that HSA. If you go onto the public exchanges, the Affordable Care Act now, those individuals who lose their health insurance, they can enroll under the Affordable Care Act under the public exchanges, if they offer high deductible health insurance plans, yes, they can. Then you could fund your HSA.
Gotcha. So, Ed, let me ask you kind of a nuts and bolts question that I think possibly some of our listeners would have right now. So they've left federal service, they haven't retired, and they're hired with a new employer. How would they connect their HSA to that to be able to contribute through payroll deduction?
Well, what they could do is, assuming that their employer offers a high deductible health insurance plan associated with an HSA.
Gotcha.
Once they enroll in the high deductible health insurance plan, then they could start funding that HSA. But keep in mind, Dan, that you don't have, there is an administrator for that HSA is being administered. I know that, you're associated with Raymond James, and you have some HSA that, and I assume the brokerage does have HSAs to offer, and that you have brokers who manage those things.
Sure.
An employee does not have to stay with that administrator. They could, what I'm saying is, if this federal employee leaves federal service and they take their HSA, they could request that the money going into the HSA, their HSA, be the one they're carrying over. They can combine their HSA with their new company HSA.
Great.
So that's an option.
Okay.
They would not be forced. And also, if the company says, well, we prefer you use our HSA, you can have as many HSAs as you want.
Gotcha.
There's no limit.
Okay.
Just like you can have as many IRAs as you want.
Nope.
You can have multiple IRAs.
Nope.
But you only can you can fund either one.
Gotcha. No, that's a great tip. So, folks, if you're counting down to September 30th, number one, our hopes and prayers are with you for finding your next opportunity, if you're retiring or not. But don't forget Ed's tip. If you've got the healthcare FSA, time to get those cool prescription sunglasses. Even if you don't have other stuff to do. So that you get your money's worth and maybe even a little bit more. And I'm perfectly fine with that.
That's right. Let's go to the website. If you go to the website, www.fsafeds.com, www.fsafeds.com, they have a list of all the types of expenses you get reimbursed for. So go to the website there, do your work, and start spend.
There you go.
Okay, it's your money. You don't want to lose it. You don't want to lose. You don't want to lose that money.
Absolutely. Well, brother, you did it again. You isolated a topic that nobody else is going to be talking about, but it could be pretty important for a lot of our feds. Let's not leave money on the table. If there's an opportunity to leave with a little extra money, that's okay too. And the only way you can do that is to know about it. So, brother, thank you for going to that level of detail on behalf of our feds. You're an awesome resource.
My pleasure.
And folks, you share this one. No joke. Share this one with every single fed you know. Okay, because there's a whole lot of people out there that have healthcare savings accounts, Lex healthcare savings accounts, and HSAs, and you need to know how to handle, because what you don't know can't help you, and what you don't know can hurt you. So let's close that knowledge gap. Share this around. You've seen us. We put the information out there. We don't pitch anything else. We just want to help you with the information you need, because we are serving those who serve. So be sure to subscribe to this podcast on your YouTube channel or Spotify. And seriously, if you're watching for the first time, please subscribe. It's not going to annoy you. We're not going to be shipping stuff to you. But what it does do is it helps us with the algorithm that YouTube uses. And the more people subscribe, they consider us to be more and more relevant for all feds out there. And hopefully we've earned that from you for this. So please do that. And also remember to share this with friends and strangers, and even throw in an enemy, that guy you didn't like so much. Okay, help him out. Don't forget our live webinars every single week featuring the guru, Ed Zerndorfer. Head to our SWS website. You'll see the webinar button. Click it. It'll take you to the menu. Sign up for one, sign up for all. The guru comes to you. Reach you where you are, teach you where you are, and serve you where you are. And share that page with your friends. Guarantee you they will thank you. Be sure to read Ed every single month, every single week, actually, in the Fed Zone. That's fed-zone.com. You can also find it at blog.stfserve.com. So don't miss that. Signing off for Ed, the crew at Serving Those Who Serve, and me, Dan Sipe. Good luck, Godspeed, and above all, remember, it's your Fed life. Make it a great one, because you deserve it. Stay well, everybody. We are out.